Hey, before we get started, I want to talk to you a little bit about our theme for this quarter, growing and protecting your portfolio. We're excited about various topics centered around this, but it really comes down to three concepts that will help you grow and protect your portfolio. You can find a PDF on our website about this. Go to wiserinvestor.com, scroll down to the bottom, enter your email address, and you'll get the PDF titled 3 Ways to Grow and Protect Your Portfolio. Thanks for listening. Welcome to a Wiser Retirement Podcast, where we cover financial topics such as retirement planning, tax planning, portfolio management, insurance, and estate planning, so you too can have a wiser retirement. I'm your host, Casey Smith. Guiding you to financial success are my co-hosts, Brad Lyons and Barnett. Hey, guys.
How's it going?
Hi, Casey.
So today's topic is an old debate in our industry. It's gone on for years and years and years, and it's active versus passive investing. And there are two very passionate sides to this debate.
And it's likely to continue for a number of years because the passion has not subsided whatsoever between the two investment styles and the two management styles.
In reality, it probably ends up in the middle. I don't know that there's a clear winner one way or the other. But I definitely favor the more passive side of investing. But there's probably listeners, honestly, that have no idea what we're talking about, and their idea of active and their idea of passive might be very, very flawed from the reality of that definition. So why don't we just start there? What is passive investing? How would we define that?
Well, passive investing, by its name, means that it's fairly hands-off approach to investing. But that doesn't necessarily mean that it's a buy and hold strategy either. What passive investing means is that as an investment style, you're choosing an investment vehicle that has a low turnover, a low cost, and a high transparency for the investments in that investment product that you're purchasing. Passive investing simply means that you are tying your returns or your to an index that has been set, and then the investment buys all the securities in the index in order to replicate the return of the index.
So the index itself, so that's like the Dow Jones, the S&P 500, things that we see on TV every single day.
Right.
But there's so many others.
There's over 1 million different indexes that are recorded today. Because essentially any manager or fund sponsor could create an index and decide to create an investment product to go along with that index if that was the case. And so there are as many indexes as you could think up, at any given time.
But there's major ones. Like
the major ones are the S&P 500, the Dow Jones 30, the Russell, indices. So yes, there are major ones that people hear about and tend to reflect the return of the overall market when they're talked about on news media.
And then there's like the U.S. bond aggregate, which represents the entire U.S. bond market, or
for fixed income products.
Correct. Yeah, which tends to be a benchmark. So that's something too. Is in an active versus passive debate is what if you're going to be an active manager? What's the what's the goal, right?
Exactly.
So in passive investing, the goal is just to replicate basically the entire world.
To replicate the index that you're trying to.
So if I was building, we call it core. So if I was building a core portfolio, it would have probably VTI, which represents the entire U.S., right? We could have VEU, which represents the entire world except for the U.S. So in those two funds, you just essentially captured the entire world in two funds. And it costs you 3 basis points,
right? And
it trades for free on most platforms.
Right.
So basically you can buy two funds. You could do 75% VTI, 25% VEU, and you've created a very diversified portfolio with just two trades.
Right.
And then if you need to de-risk that, you would add something like BND, which is the bond.
Right. Or BNDX, which represents the bonds
foreign.
Outside the United States.
That's true. Mm-hmm. That's true. So by doing that, you set it there and you just forget about it. That's
Well,
that's the beginning of passive.
That's right.
With no manager whatsoever.
Right. The ultimate passive portfolio to set it and forget it.
Right.
Right. And that would, for a lot of people, that would be successful, quite frankly, if they just would leave things alone and not tinker with it. But that's not necessarily what passive investing necessarily is meant to be. These are instruments that are used in a passive investment management style in order to achieve a specific return over a long period of time. So there are, as you said, many, many, many indexes, and fund sponsors have created investment products to go along with those to satisfy the needs of the investors, investment requirements. So,
but those are what I consider true passive funds, because they hit a couple of marks. One, they have low fees.
Right.
They're transparent.
Meaning that what they're investing in, and why they're investing in them.
Yeah, there's no secret. They report. Some of them report maybe monthly. Some report daily what the holdings are, and then they're very tax efficient. Right. Partially, the tax efficiency comes from you not trading it, because dividends just get reinvested and just keeps building over time. You really don't have any tax issues by holding that, other than maybe income and dividends. But where are those right now?
Yes, and ETFs have the unique redemption creation process to them that hides the capital gains that may occur inside the fund itself. Whereas mutual funds, although they may be passively managed, they still may pay out a capital gain depending upon if the index itself changes from time to time.
That's true.
You're right.
The biggest issue with the buy and hold that we hadn't talked about with passive investing is, while it is great, the problem that you run across is, depending on market performance, you can be very heavily overweighted equities or underweighted bonds at some point. So that's really the main thing, is we are rebalancing at some point and not staying strictly passive, which is kind of the difference between straight passive buy and hold and overall passive investing with some rebalancing options.
Yeah, the rebalancing there is really just managing your risk. So if you're a moderate investor and you're in a 60-40 portfolio, and the 60% stock over the last couple of years has now grown to 70% stock, right, and the bonds are now underweighted, you would simply sell some of those gains in the stock and buy back more bonds in order to maintain your risk level. Otherwise, you're on the next downturn, you're taking more risk because it's grown outside your risk profile. So that's the importance of rebalancing. The highest rate of return comes from not rebalancing, actually, because equities typically go up over long time periods.
Right. They go up at a faster rate than the fixed income does. And so you become overweight more and more and more in your portfolio.
But does rebalancing make you an active investor? I don't know that it.
I don't think it would, but it's not technically buy and hold. Buy and hold, would you buy it and never look at it again?
Right.
True.
Right.
Yeah.
Right.
So I say that you're still a passive investor. You're just managing the risk of that portfolio.
Yeah, to your risk tolerance, which we're always doing for clients, is making sure it is aligned with their goals.
But even though the conversation, if you will, between active and passive managers has gone on for years, we're finding that more and more in the investment world, that not only do individuals buy into the passive management style, but institutions have as well. Institutions are big buyers of passive management. They also utilize active management in their portfolios quite often as well. So this blend that you talked about earlier, we're seeing some of that occur in the marketplace now, where investors, especially the large institutional ones, are utilizing the tax efficiencies, the low cost, and the exposure to the asset class all by itself through ETFs and investment mutual funds that follow a passive strategy, along with active style within it. So it's not unusual to see a little bit of both in that. So, but the passive management has grown in popularity over years, and is now actually having greater inflows into that management style than active management is having currently.
There are some perceived disadvantages to passive investing. I don't see them as disadvantages, but they say that on the active camp that, well, you're limited to market returns, meaning that you could never get anything greater than the market because you own the market, right? So if your job is to beat the S&P 500 and you're invested in the S&P 500, you might beat it in a weird year, but you're going to beat it by a very small basis point, right?
Well, the point of active management is to try and outperform the benchmark. Okay, so the active manager is saying, well, if you are the benchmark, then you can never outperform it. So that's a disadvantage to the shareholder. We don't see it that way. And we'll get into different reasons for that, in a little bit in this conversation. But when they say that you're limited to your investments, it means that you can't hide from any investments or any sectors that become out of favor at any given time. Whereas the active manager says they can sell those positions in their portfolio and try and avoid downturns in his sectors or company specifics. But that isn't necessarily the case always, because they have parameters in their investment management style as well. And they have to essentially market time the market, if that were the case, in order to avoid a sector or a company perceived future returns. So it's a false argument to say that you're limited to to your returns.
Yeah.
When you invest in ETFs and index related products.
So let's better define active investing then. So if you're going to be an active investor, I think one of the main criteria is you're participating in market timing.
Absolutely.
Because you're just as you said, your sole purpose is to
beat the index.
An index.
Right. Your benchmark. So in order to do that, you have to look different than the benchmark. Okay. And that's called active share in the business. And the higher the active share, the higher differential you have from the benchmark. But as you move away from the benchmark, you increase the risk of your portfolio as well.
And that's what we see a lot. We'll talk about this in a minute, but we see that funds that actually, managers that actually beat the market, or even individuals, or even maybe other small advisory firms and say, yeah, we beat the market on a consistent basis. You have to adjust that for risk.
That's right.
So if you're invested in the S&P 500 and it has a standard deviation, let's say 15, so that means that your average rate of return, let's say it's 8%, and it deviates by 15
either way, right? Up or down.
But your rate of return is 10 from whatever you do, but your standard deviation was 25. Yes, you beat it, but you took on more risk. So if you added more risk to a passive investment portfolio, like maybe you worked in small caps or emerging markets or something, and you took on more volatility, and thus you got a higher rate of return, it's
what's supposed to happen.
It's what's supposed to happen. But we see that a lot when we get asked to do comparisons. We say, hey, I'm with this advisory firm, I want to hire you guys to come in and give me a second opinion. And we say, okay, well, performance is actually not bad, but your risk is a lot higher than what you probably think that you're getting. So your downside is going to be a lot bigger when it happens. We're in a great 10-year span with a few little blips. The COVID blip, everything went down as one for a couple months there. But the downside risk can be much greater, and people don't necessarily see that. Which is why we see active managers will typically outperform in the short term, but they can't outperform in the long term.
Well, the reason why active managers can and sometimes do outperform in the short term is because their investment management style and the trend or momentum that's taking place in the marketplace match up together. And so they're like riding a wave at that point in time. But we all know what happens when waves hit the beach.
Right.
They crash. And it's very difficult for a manager to find that next investment trend or investment wave in order to ride it. I think a great example is the Cathie Wood, who manages the ARC funds. Great manager, really tremendous returns in 2020. She rode that wave. Her investment management style and the marketplace matched up beautifully. But since then, she's had a little bit more difficulty, getting the returns that she had had in the previous years. It's not unusual because less than 30%, I think, of managers who do beat the market in any given year are able to do it again the second year because the trend changes. It moves away. And then the manager is left with the assets and the investments that they had the previous year, and those become out of favor.
Yeah.
And like you said, it's a cycle. Every couple of years, they need to change. Or really, as an investor, you need to change out of that investment every couple of years.
Right. The advantages to active management would be flexibility. So you'd have the ability to move in and move out of certain sectors. But we fight this with some clients now, maybe with on the bond side, right? And saying, why do I have this bond fund? Why do I have this bond fund? It's like, well, there's a reason why you have a bond fund.
Right.
and that's a whole nother podcast. But active management gives you that flexibility to be able to kind of hop in and hop out. It gives you the ability to hedge. Like, I don't know why you would ever hedge a passive portfolio.
Right.
It doesn't make a whole lot of sense to me.
Well, a lot of those active bond funds too actually aren't really bond funds. They can have equities in them. They can be high yield, and so they're not actually.
They do a lot of currency trading in those,
right?
Quite often too, and you got to be careful about that.
Right. So the returns might be a lot better than the standard ag, but you're taking on a lot more risk when it actually matters at some point.
In an area of your portfolio where you're trying to de-risk.
Exactly. Yeah.
Right. So that's a good point.
The disadvantages, obviously, of active management is it's usually very expensive. The good funds, the good managers cost the most.
Right. Well, you're paying for staff of people who are analyzing securities or analyzing the markets. They have CFAs and they have degrees from pedigree colleges, and all that costs money. And on the passive side, you still have portfolio managers and you have administrators, but they're not actively analyzing every security in the portfolio, spending time and energy and effort doing that. So
right.
The costs are just lower.
Because they're just replicating whatever the index is.
That's right.
And the S&P 500 actually has a committee who decides who's going to be on the S&P. And there's criteria, but they still have to pass through committee.
Right.
So on the S&P 500, if you have like a Vanguard or an iShares S&P 500 index fund, all they're doing is just buying whatever the committee has decided. I mean,
that's right.
I don't call them fund managers. I call them fund administrators because that's really what they are. They're just making sure that the product trades smoothly and efficiently through the market.
Exactly.
Is their responsibility. So, it's if you think about different levels of investment, so you have large cap, mid cap, small cap, foreign, emerging markets, and then you have bonds. There's a common thought that, okay, no one can really beat the S&P 500. Like, it's over a 20-year period, it's not really probable that you beat the S&P 500 yet. It's kind of funny. That's where a lot of firms like ours, that they manage individual stocks at the large cap level, and then they use index funds for all the satellite positions. And they actually have that backwards. They'd be better off just buying the S&P 500 and then possibly using active management for small, mid, foreign, emerging markets. But that trend's actually reversing, where we're actually seeing that it's really not more advantageous to be active at any asset level. You look at active bond funds; they've gotten completely annihilated by B&D, or not necessarily B&D, but the aggregate over the last decade, because they've been wrong, as have a lot of other people. Bonds are kind of funny right now,
right?
But the point is that when you invest in a fund manager, you're taking on manager risk. And people don't always see that.
No, they don't. And when you invest in a fund manager, you're outsourcing your investments to this person to manage it for you, or their team, or their group. And what you were alluding to, whether like large cap, mid cap, and small cap, is that all publicly known information at any given time is presumed to be efficient. That is one of the ideas of investing, is whether you have known information when you make your investment management decisions. So in the large cap, you have analysts covering all these companies in the S&P 500. So it's presumed that there's no inefficiency, that all information is known, that every manager and every analyst has the same information, and they can either see it one way or another, but they don't have any advantage over one another. When you got into the mid caps, and especially even more so into the small caps, It was presumed that there weren't as many analysts covering some of these companies. There's just so many. The Russell 2000 small cap index, as it says, there's 2,000 companies to cover. That's very difficult, if not impossible. So any one particular analyst or any management team for investment mutual fund, for example, if they found a company that was not being covered, they might have an advantage because the information base isn't publicly known at this point in time. Okay, it's not efficient. As more and more analysts get into the business, as the use of software and these things where companies become more efficient at reporting their financials to the analyst world, that's efficiency is getting greater and greater and greater, both at the mid cap and small cap level. So it's becoming even more and more difficult to exploit information in the small caps than it was in the past.
Yeah. So
it's becoming even more and more difficult for small cap managers to beat their small cap benchmarks.
What we always tell people is invest for the long term, right? That's our whole theme for this quarter in our podcast is keep costs low, maintain diversified portfolio, and focus long term. But what does long term mean? You think about that, people go, oh, 2-3 years. Well, I'd say that if your money's supposed to be invested for 3 years, it shouldn't be invested. You just shouldn't even be in the market. I mean, that's what you tell people during the financial planning process, right?
I mean, that's probably one of the most common questions we get is, I might need this money in the next few years. I'm earning 0.4% as savings, as high yield savings account. Inflation's going up. What do I do? Well, if you need the money, then it's probably not in the next few years, year or two. It's probably still not something you need to be invested fully in the market. It's just kind of the environment we're in right now.
I have a chart here that I found. It's a little dated, but it goes from 1926 to 2011. So I was looking at all these ranges. It was something that I had just from a presentation from many years ago. But 1 year period, so 1 year time period. If we're going to invest the money for 1 year, you have you could get a 54% rate of return historically, or you could lose 43%.
So that's your range of possible.
That's the range. Anywhere in there. You could lose 43, you can make 54. If you're going to invest for 3 years, you could make 31, or you could lose 27. Okay. I mean, I'm not a gambling man, but that's a little better.
Yeah.
A 5 year period, up 28% or down 12. That's a lot more manageable, right?
Right.
You want to go out to a 10-year period. I didn't think there was a 10-year period where you actually lost money, but evidently there was one. But you're down 1.4% or up 20% over a 10-year period. You want to go out 20 years, you've never lost money. It's never happened. Up 3.1% annually is the worst case scenario. Best case scenario is 17.9.
Over 20-year periods.
Over a 20-year period.
Yeah, exactly.
Yeah.
Right.
So when you say focus long term, that's what we mean. We mean 10 plus years, but we're really focused on that 20-year mark. And so when you build portfolios, you want to build them with what we call long-term healthy asset classes. So every single fund in our portfolio is representative of an index, and it's always made money. It's never lost. Right? Mm-hmm. Now, does it mean that it didn't lose over a 1 year?
Well, it may have had a decrease in value.
Correct.
Right.
3 year, 5 year, 10-year time period doesn't mean that it was out of favor at any particular time. But that's basically the rock solid foundation of passive investing is the fact that active managers over this 20-year period aren't going to do you much favors. So it's really more for the short term. That makes more sense to me is why you'd have active managers is more for the short term than the long term. I mean, honestly, we joke about this, but we're half serious. Why wouldn't you just invest all your money in the S&P 500? You just put it all in there. I mean, that's not how we manage money, but I mean, you think about that. Like, give me a time period where that was a terrible idea.
The index itself is said to cover over 80% of the marketplace, of the returns of the marketplace.
Especially now.
Yeah. As we get into these mega caps,
and these are global companies
that are driving, returns these days. So absolutely.
We talked about rebalance. I mean, to your point, 2007, 2008. If you could stomach 50% drops,
that's the hard part.
Yeah, exactly.
That's
but
the hard
other
part.
than that, in the long run, like you mentioned, it rebounded and it's done great. So you just gotta have it. That's what goes back to the buy and hold. It's not actually the fact that we're not maybe doing a little active management on the way that we rebalance portfolios, but that you're not getting in and out of the market. You're not going to cash. You're not going to bonds. You're still invested to your asset allocation over that long time period.
It's building a passive portfolio, but making active decisions about how to manage that portfolio.
Right.
That's where we're adding alpha. We're adding value to the portfolio as managers. Now, I think most of our value comes in the form of planning, because most people have no planning or poor planning. And so we're able to help plug in gaps and say, okay, you need to make these changes. There's more than one way to lose money. It's not just the stock market. You can do other things.
That's true.
So financial planning is what you should be paying an advisor for. Portfolio management will be a part of that, but it's a smaller part of that.
Yeah, I mean, beating a benchmark's not going to do you a whole lot of good if you're not living within your means or spending too much or not saving enough. You got to focus on if you're on track first.
Not having proper estate planning done, so you're going to leave it to Uncle Sam.
Right.
Or not having the right kind of insurance, so your house burns down, but you don't have enough money to put it back together. You lose wealth that way. Or it might, terrible. You're at fault for something, and you don't have enough coverage. So
right.
there's a lot of different there's a lot of different scenarios, and as the higher the assets, the more bigger the complications get, and what predators out there would be trying to extract out of you financially. But that's a whole nother rabbit hole we don't need to go down. But the point is that I feel like so many advisors or firms are actively trading simply because they feel like they have to show their worth. And that's not how you show your worth as a financial advisor.
Well, no, on the brokerage side of the business, that's their business model, though, is to buy and sell securities on behalf of their clients. So that they're doing what their business model demands for them to do.
Because that's how it started many decades ago, where they only made money if they made a trade.
Correct.
The old stock jockeys. And
transactional commission.
Yeah. And so, but they're still doing that. They're just doing it in a different view.
Right. It's a different format that they present to the client right now.
But it's
still underneath it. It's buying and selling securities.
Yes, correct. That's the whole point. And at the really big firms with ultra high net worth people, it even gets more complicated, because you have Goldman, and you have them on both sides of a trade. So you have them contacting you, say, hey, I've got this great fund for you. In the meantime, they have another client who's, maybe betting against you, right? Or maybe the firm's betting against you. Even they don't have to tell you that stuff. But anyway, the point is that the value of a financial advisor is not in the number of trades that they make. It's about getting you safely to the destination, right? I use the airline pilot analogy all the time.
Yeah.
It's real simple. You take off, you rotate off the runway, one of the engines catches on fire, you do nothing. You fly the airplane, you make sure that you get to a safe altitude, you pull out this book, you run a checklist, and you know what? If the engine burns up and falls off, which happened in that United 777 out of Denver, was it last year or year before last? It's designed to do that, right? And yet everyone in that plane got back safely. And a lot of that translates into risk management and portfolios. Sometimes the best thing to do is absolutely nothing. It's like, at times the stock market is like talking to an irrational person. And sometimes when you talk to an irrational person, you realize that this person's never going to understand like my point, or that I'm right, or whatever, or they're harming themselves. And what do? You have to walk away from it. And you come back and reevaluate when they can talk.
Well, one of the advantages of hiring, at a financial advisor firm like ours is that we take the emotion out of the investment management, investment style. And we simply look at the market relative to a portfolio, relative to an investor's objectives. And those are the elements that we put into our decision making. Whereas quite often emotions get in the way and they muddle the person's thought process, and it becomes confusing and becomes frustrating, and they begin to shut down on us. We see this over and over and over. By hiring somebody like us, we help them through these decision makings, and we keep them invested for their own good.
So all this sounds great, and we didn't mean for that to be an infomercial, but we're very passionate about what we do and how we do it. But there is a scorecard. So this active versus passive, there's a scorecard for this. It's produced by S&P. It's done every 6 months. So we don't have one for 2022 yet. We have midway through 2021 was the last report. We'll actually put this in the link in the show notes if you want to go and find this yourself. It's an email I'll look for usually around June that'll come out with the next version, or I guess it'll be one sometime in January for the last half of 2021. So the SPIVA report is produced every 6 months, and it shows active versus passive managers, right? Active management versus the indexes, really. They have a methodology that they use. So, they have, really it comes down to 5, survivorship bias correction. So many funds might be liquidated or merged during a period of the study. These are accounted for, and it's not just the survivors that are accounted, because then the funds that survived would be obviously probably the better ones.
Right. And the premise is there that the ones that didn't survive were the lower performing funds.
Right. So they take into account a survivorship bias correction in their report. They do make an apples to apples comparison. So regardless of size or classification, basically it's making sure that they're using the proper benchmark. Because a lot of times you just compare a mutual fund to the S&P 500. But it may not actually be in the S&P 500. It might have half its money in small caps or half its money in mid caps. So they actually adjust for how the fund's actually invested and what appropriate benchmark would be. They look at style consistency, making sure that if they had better performance, they didn't just change how they're invested. And then asset weighted returns. So they actually use average rate returns of a fund group are often calculated using only equal weighting, which results in the returns of a $10 billion fund affecting the average in the same manner as the returns of a U.S. dollar $10 million fund. So a more accurate representation of how market participants fared in a particular period is found by calculating weighted average returns, where each fund's return is weighted by its net assets. SPIVA scorecards show both equal and asset weighted averages. And we have data cleaning, which is the final one, where we have multiple share classes, and they're combining those into one is how I believe that works. It also excludes index funds, leveraged and inverse funds products. So we're not using any of those type of products when we're comparing. So there's no index funds in the report, and there's no leveraged funds in the report. And most of these would be mutual funds, not ETFs, right? Because ETFs tend to be technically passive. tracking an index, which could be active. That's very confusing. So these are more your classic mutual funds. Probably a lot of these you'd find in a typical brokerage account at any big advisory firm. So what I find is that my favorite report, it's I don't know how many pages was this thing, like 35 pages. My favorite report is the risk adjusted returns. So if you look at all domestic funds, so just that means these are like all cap. They invest in large, mid, and small in the U.S. Over 3 years, 75% underperformed the benchmark. That's a big number over 75 years. Over 5 years, 78, so about the same number percentage. over a 10-year period, 92% underperformed, and over a 20-year period is 93.8, call it 94%. So 94% of all cap managers underperformed. Now, in a space that is probably more easy to quantify for people, large cap funds, which would be the S&P 500, 68% in the short term. We talked about that earlier. In the short term, they tend to beat, right? But still, that's a very small percentage that we're doing it.
Right. So really, it's the inverse that does it. So 32%
yes,
beat the benchmark.
74% over 5 years, 89% over 10 years, and 94% over a 20-year period.
Failed to beat
the
benchmark.
Correct.
Right.
And
when we're talking about our investment time period, we're talking long term. So here it is.
Yeah.
It's right there.
Right.
There's the 20-year, the 10-year, the 5-year, and the 3-year.
And then in the small cap space, where you expect them to outperform, like small cap growth, over a 20-year period, 98% failed to beat the index over a 20-year period. Now, in the short term, though, over a 3-year period, 18% failed to beat the index. That means nearly over 80% did really well in the short term. But you keep holding that fund over a 20-year period, it underperforms. So, look, our job is to get people to the finish line, which typically is age 95 without running out of money, right? And living a quality of life that they want. So if we're betting on success, I would bet on the passive side, because it's telling me right here that I have a 90, on average, looking across all these, a 92% chance.
Take those odds
of beating any other strategy if I go with the passive index funds.
You have better odds at Vegas.
I know, right? Right. So, that just, again, there are some bright spots, some active managers in real estate, which they pointed out in their cover page. Active managers in real estate over a 3-year period look pretty good. Even a 5-year period, it kind of falls apart again at 20 years. 80% still underperforming. Mid cap. I don't know why anybody would have a mid cap fund manager based on these numbers. So it's you just have to be patient. You have to understand there are going to be times when other strategies in these mutual funds are maybe outpace you in a passive environment, but understand over the long term you're going to be the winner. That's what the data supports.
The passive style of investment it really is the know what you own and why you own it for the period of time that you plan on owning it. Right. And that's the whole point. It's transparent. You know what you have. You know what you're buying into. You know what you're paying for. Okay? It is the ultimate investment for somebody trying to achieve their objectives through investments.
And and that's our approach. I mean, the average cost of our portfolios are now down to 0.005%. Everything trades for free now on the Schwab and TD Ameritrade platforms. Mm-hmm. So the cost of investing is basically zero right now. So it's now even a harder time to beat the index funds.
Exactly.
Because the cost is so low.
The average active mutual fund is in the 1% fee range.
Yeah, and those have been coming down too.
They're coming down a bit, but yeah, they have to beat that before they can even beat the index.
Yeah, I mean, they were higher, but it's not rare to see them 0.5 still right now if it's not a asset-based one.
Right.
So it's pretty significant.
So kind of going back to the beginning, I do wonder, in ETF world, we have we've created all the passive ETFs. Now we have active ETFs. We have factor-based ETFs. We use one in our portfolio. It's Quality, QUAL. It's a quality screen for large and mid-cap stocks. Is that considered active or passive?
Well, they're active in that they're constantly searching for appropriate companies to put into their index, but they're passively managed relative to, as long as they come through the screen, they remain in the portfolio.
Yeah. I'm a purist. I think that it's the S&P 500 is passive. And if you do anything out beyond that, then that's considered active. So I see qual as an active strategy, which is fine.
Mm-hmm.
It's its benchmark's a little different, I guess, because it is a benchmark in itself. It's a benchmark of quality funds or quality companies. But that's neither here nor there. That doesn't really change anything if that's considered more active. But sector rotation, so you can be active. You can buy ETFs that only cover certain sectors of the stock market, and then you rotate those every year or every quarter based on certain parameters. That's definitely an active strategy, but still using passive funds
vehicles to implement it. Right.
So your holding period is probably what helps you be more passive than. It goes back to market timing. We don't participate in market timing.
Mm-mm.
Therefore, we're not active managers. But we do make changes to the portfolios as opportunity presents themselves.
That's right. That's right.
We could talk about this forever, guys. So good conversation.
Sounds great.
Enjoyed it. Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.